Retiring with both a pension and Social Security, what most people get wrong before they sign. There's a phrase I hear constantly from people who are close to retirement and happen to have both a pension and Social Security. It goes something like this. We think we're in good shape. We just want somebody to confirm it. And that confidence, that feeling of being set, that's actually where a lot of the risk quietly hides. Because having a pension and Social Security doesn't make retirement simple. In some ways, it makes it more complicated. Not because anything is wrong with your situation, but because now you're not just asking whether you can retire. You're asking how you structure the income, how you manage the taxes, how you time everything, and, if you're married, how you make sure your spouse is protected if you're the first one to go. At some point before you retire, someone is probably going to sit you down, hand you a form, and ask you to pick your pension options. Research shows that most people make that call in under 30 minutes. A lot of them never see the full picture of what they're actually deciding. This video is about making sure you see it clearly. Let's start with something that trips a lot of pension holders up before they even get to the complicated stuff. People tend to measure retirement readiness by account balances. They look at their 401k, compare it to whatever number they've seen floating around online, and if it feels modest, they worry they're behind. But that comparison completely ignores what a pension is actually worth. There's a planning benchmark a lot of people have heard of called the 4% rule. The basic idea is that $1 million portfolio can generate roughly $3,300 a month in sustainable withdrawals. So by that measure, a $3,300 monthly pension is economically equivalent to having $1 million sitting in an investment account. And if you tried to recreate that kind of guaranteed income by purchasing an annuity on the open market, you'd spend hundreds of thousands of dollars doing it. That's what your pension is worth. It's already paid for. You can't outlive it. You can't lose it in a market downturn, and you don't have to manage it. Now add Social Security on top of that, and you have a foundation that most Americans spend their entire working lives trying to build. But here's the thing. Even though guaranteed income is genuinely powerful, it has a vulnerability that a well-invested portfolio doesn't. And that vulnerability is inflation. Most private pensions have no cost of living adjustment built in. Some offer a modest 1 or 2% annual increase, but even then, how that increase is actually calculated matters a lot more than people realize. There are two types. A simple COLA applies the increase to your original benefit amount every year. A compounding COLA applies it to the prior year's amount, so the raises build on each other over time, same as compound interest. The difference between those two approaches over a 30-year retirement can add up to tens of thousands of dollars, sometimes more. Worth knowing which one you have. Here's a realistic example of what inflation can do to a fixed pension. Imagine a retiree who leaves work at 62 with a pension paying $4,200 a month. No cost of living adjustment. That feels solid. But if you model what that $4,200 is actually worth 20 years later, using just 3% annual inflation, it comes out to somewhere around $2,300 in today's purchasing power. The check doesn't change. The number on the paper stays the same. But what it actually buys has quietly been cut in half. And over that same period, healthcare costs have gone up. Property taxes have gone up. Insurance has gone up. The pension just hasn't. That's the quiet erosion that a lot of pension holders never plan for. And this is exactly why Social Security becomes so important over time, and specifically why delaying it can matter more than most people think. Social Security's annual cost of living adjustment is compounding. The longer you've been receiving it, and the higher your starting benefit, the more meaningful those annual increases become in real dollars. So a larger Social Security benefit, growing and compounding over 20 or 25 years, provides real protection against the inflation exposure that a flat pension can't address. The pension is the foundation. It's a strong one. But the rest of your retirement plan needs to be built around what that pension cannot do. Now let's talk about something that most people with both types of income never actually think through: the order in which you turn those income streams on. Most people assume that when they retire, both sources of income start more or less at the same time. They don't have to. And the sequence in which you begin drawing them can have substantial long-term implications. Here's the core insight. Your pension benefit is typically fixed once you reach a certain age. But Social Security is different. Every year you delay claiming past age 62, up until age 70, your benefit grows by roughly 6 to 8%. That growth is guaranteed, permanent, and inflation-adjusted. That's not a market return. It's a contractual increase backed by federal law. So if your pension can cover most of your core monthly expenses, you may be able to use it as a bridge, letting Social Security keep growing while you live off the pension, until that benefit becomes a significantly larger, permanently inflation-protected income stream for the rest of your life. Put some numbers to it. Suppose you retire at 62 with a pension of $3,200 a month. Your monthly expenses run about $5,500. That's a gap of $2,300. Option 1. Claim Social Security at 62 and receive roughly $2,100 a month. Gap is essentially closed. Option 2. Wait until 70, when that same benefit could grow to around $3,700 a month. During those 8 years, you draw from an investment account to cover the gap, about $2,200 a month, which comes to roughly $220,000 over that period. For anyone with a meaningful investment account, that withdrawal rate is entirely reasonable. At age 70, under Option 2, your combined guaranteed income is now $6,900 a month against $5,500 in expenses. You have a surplus every single month for the rest of your life. And because Social Security is inflation-adjusted and continues compounding, it gradually compensates for the flat pension eroding beside it. Option 1 would have been quietly losing ground the entire time. There are legitimate reasons to claim early. Health, personal circumstances, financial need, those things matter. But if longevity is on your side, the math on delaying is hard to argue with. And there's another dimension to this that most people completely miss. It connects directly to taxes. That window between retirement and when you start drawing Social Security, whether that's a few years or as many as 8, is actually one of the most valuable tax planning opportunities of your entire retirement. During that period, you have pension income, but no Social Security income, and likely no required minimum distributions yet. Your taxable income may be lower during those years than it will ever be again. That's your Roth conversion window. If you have a substantial traditional IRA or 401k, converting portions of it to Roth during those lower income years can reduce your lifetime tax burden significantly. When required minimum distributions eventually kick in at age 73 or 75, added on top of a pension and Social Security, you don't want a large traditional IRA adding more taxable income to an already taxed-up picture. People who plan this well can save 6 figures in taxes over their lifetime. People who ignore it often end up overpaying for years without realizing it. The income sequencing strategy and the tax strategy are really the same strategy. Most people treat them as completely separate decisions. They're not. Now, before we get to the pension election itself, there's a law change from early 2025 that's worth covering. If you have a government pension, this may have already changed your situation in a meaningful way. In January of 2025, the Social Security Fairness Act was signed into law. It eliminated 2 provisions that had been part of federal law for nearly 4 decades: the windfall elimination provision and the government pension offset. These rules had reduced or, in many cases, completely eliminated Social Security benefits for people who received a pension from a government job that didn't pay into Social Security. Teachers, firefighters, police officers, many federal employees, over 2.8 million people were affected. Under the old rules, your Social Security benefit could be significantly reduced simply because you also received a government pension. The GPO specifically affected spousal and survivor benefits, and more than 70% of people impacted by it had their entire spousal or survivor benefit reduced to 0. All of that is gone now. Benefits have been recalculated. Some people are seeing increases of several hundred or even several $1,000s a month, with adjustments going back retroactively to January of 2024. This doesn't apply to everyone. If your pension came from an employer that withheld Social Security taxes, the WEP and GPO never applied to you in the first place. But if you were told your benefit would be reduced because of a government pension, or if you never applied at all because you assumed it wasn't worth pursuing, that calculation may have completely changed. And Social Security is not going to proactively reach out and tell you about this. The responsibility falls on you to follow up and apply. Now, whether that law applies to you or not, the next decision we need to cover applies to every pension holder. And it's the most permanent decision you'll make in retirement. When you retire, your pension is going to ask you to choose how you want to receive it. Most people think there are 2 options: take the full monthly benefit, which stops when you die, Or take a reduced amount that continues to your spouse after you're gone. Some pension plans also offer a third option, a lump sum, and that option often doesn't get the attention it deserves. If your pension has no cost of living adjustment, the lump sum deserves a serious look. Your pension administrator will typically show you a break-even calculation. How long do you need to live for the monthly benefit to come out ahead of taking the lump sum up front? If that break-even stretches into your 80s or beyond, rolling the lump sum into an IRA gives you immediate control over a significant pool of capital. You can invest it, grow it, use it for Roth conversions, and pass whatever remains to your heirs when you're gone. The monthly pension, by contrast, ends with you or your spouse. Nothing passes to the next generation. On the other hand, if your pension includes a compounding COLA, the math usually favors keeping the monthly benefit. An inflation-adjusted pension becomes more valuable the longer retirement goes on, and giving that up for a lump sum is much harder to justify. Simple framework. Pension with a COLA, the monthly benefit almost always wins. Pension with no COLA and a distant break-even, the lump sum rollover deserves a real conversation. Assuming you're taking the monthly benefit, the next question is how to structure it for your spouse. And this is where a lot of people sign without fully thinking it through. Here's a situation that plays out more often than it should. A couple retires. The husband is healthy. They have savings. He chooses the single life pension option to maximize their monthly income. Less than a year later, he passes away unexpectedly. The pension stops immediately. His wife is now managing a sharply reduced income, filing taxes as a single filer, which means higher rates and a smaller standard deduction, and potentially facing higher Medicare premiums on top of it. All at once, in the same month. They didn't make a reckless decision. They just never modeled what would happen if he went first. Think of the joint and survivor option this way. It's essentially buying insurance through your pension. You accept a reduced monthly income as the premium in exchange for a guaranteed payout that continues to your spouse after you're gone. Say the full benefit is $4,500 a month. The 50% joint and survivor option reduces that to $3,600. You're paying a $900 monthly premium, about $10,800 a year, for that coverage. If you pass at 75, your spouse receives $1,800 a month for the rest of their life. Now consider an alternative. What if you took the full $4,500 instead and used that $900 a month to fund a life insurance policy outside the pension? Depending on age and health, that could mean a substantial death benefit paid income tax-free to your spouse, with full flexibility over how it's used. Your spouse could invest it, use it for healthcare expenses, or pass it on. The pension survivor benefit is fixed the day you sign. The insurance approach preserves flexibility. This strategy is sometimes called pension maximization. It doesn't work for everyone. Health conditions, insurability, and age gaps between spouses all affect whether the math holds. The point is that most people make the pension election without ever seeing the comparison laid out clearly, without realizing they're effectively buying insurance through that election, and without asking whether there might be a better way to structure the coverage. And once you sign, there's no changing it. That permanence alone is reason enough to slow down and look at the full picture before you decide. There's one more piece that almost every retirement plan misses, and it tends to hit surviving spouses harder than anyone anticipates. What happens to your spouse's income the month you die? When one spouse passes away, several things happen simultaneously. The smaller of the two Social Security checks goes away immediately. The surviving spouse keeps only the higher benefit, just one check. If you spent years building a larger benefit by delaying to 70, that higher amount is what your spouse is left with for the rest of their life. Which is exactly one of the most overlooked reasons to delay claiming. It's not only about your income, it's about the income floor you leave behind. Depending on the pension election, the pension either stops entirely, drops to 50 or 75%, or continues at the full amount. The surviving spouse now files as a single filer, meaning the same income gets taxed at higher rates with a smaller standard deduction. Medicare surcharges that didn't apply before may start applying. And the fixed expenses, mortgage, utilities, property taxes, they don't move. Income drops. Expenses don't. Every retirement plan should model two scenarios with equal seriousness: life together and life as a survivor. Not as a worst-case backup, but as a core planning scenario. If there's a gap in the survivor picture, and there almost always is, It needs to be addressed before retirement. Through Social Security timing, through the pension election, through life insurance, through how your assets are titled and structured. Protecting your spouse isn't one decision. It's the sum of all the decisions we've covered here today. These pieces, the value of your pension, inflation exposure, income sequencing, the Roth conversion window, the pension election, survivor income planning, they're not separate topics. Every one of them connects to the others. And making one decision without understanding how it affects the rest is how people end up in situations they didn't anticipate. If you're within 5 to 10 years of retirement and you've never had someone sit down with you and model all of this together, that's the conversation worth having before you sign anything.